Hello everyone and welcome to Lesson 5. We are going to tell you all about pips, lots and how to use leverage in Forex trading. It might all sound confusing just now, but stick around and we will explain everything. You might never have ever heard these words before, and definitely we are not talking about pips in oranges. We are talking about pips that make you profits in Forex. Lots of a really odd word to explain a transaction amount, but we will go into details in the lesson. Leverage is very important as it allows you to trade big amounts with a small deposit. So let's start. Make sure you like, subscribe, and turn on bell notifications. It really helps the channel to grow. Before we jump into the lesson, a quick disclaimer. Smart Forex Trading offer educational videos to help and educate Forex traders. Information on this channel is for educational purposes only and should not be considered financial advice. We must advise you Forex trading carries a high level of risk, and you should be aware of the risks before trading in Forex. Welcome to Lesson 5. In this lesson we are going to explain what is a pip, what are lots, and give you an insight into how leverage works in Forex. There will be a lot of technical words, but don't worry, we will explain everything clearly. Let's start with pips. You might be asking, what is a pip? Pip is an acronym for price interest point. A pip in simple terms is the value of a currency to 4 decimal places. Don't worry if that did not make sense straight away, as I am now going to explain in full details. A pip is the price move in a given exchange rate. Understanding the change in value helps traders to enter or edit orders to manage their trading strategy. What is the pip value? The pip value is the price attributed to a 1 pip move in a Forex trade, which can vary between currencies. As most major currency pairs are priced to 4 decimal places, a pip is usually equal to the 4th figure after the decimal point. For example, in pound sterling to US dollar, for instance, 0.0001 is 1 pip. I don't want to confuse you, but there are some exceptions, such as the Japanese yen that is only quoted to 2 decimal places. In these cases, the pip is the second digit after the decimal point. Although most Forex pairs will be quoted to 2 or 4 decimal places, there are some Forex brokers that display an additional decimal, known as a pipette or micro pip. Let me give a quick example of a pip. Let's take a look at the euro to US dollar currency pair. If the market moves from 1.1600 to 1.1601, that 0.0001 increase would be a single pip move. If you had entered a long position on euro to US dollar, and the market moved from 1.1600 to 1.1650, you would have gained 50 pips and profited from the increase. But if the market moved against you, falling from 1.1600 to 1.1550, this decline of 50 pips would mean that your position made a loss. Let's now look at how pips work. A pip is a basic concept of foreign exchange, Forex. Forex pairs are used to disseminate exchange quotes through bid and ask quotes that are accurate to 4 decimal places. In simpler terms, Forex traders buy or sell a currency whose value is expressed in relation to another currency. The movement of a currency pair determines whether a trader made a profit or loss from the positions at the end of the day. A trader who buys the euro to US dollar will profit if the euro increases in value relative to the US dollar. If the trader bought the euro for 1.1835 and exited the trade at 1.1901, they would make 1.1901 to 1.1835 equals 66 pips on the trade. Key takeaways. For currency pairs with 4 decimals, 1 pip equals 0.0001. For yen-based currency pairs with 2 decimals, 1 pip equals 0.01. When trading metals, gold and silver, 1 pip equals 0.01. What is a pipette? There are Forex brokers that quote currency pairs beyond the standard 4 and 2 decimal places to 5 and 3 decimal places. They are quoting fractional pips, also called points or pipettes. If the concept of a pip isn't already confusing enough for the new Forex trader, let's try to make you even more confused and point out that a point or pipette or fractional pip is equal to 1/10 of a pip. For instance, if pound sterling to US dollar moves from 1.30542 to 1.30543, that 0.00001 USD move higher is 1 pipette. Now that you understand what is a pip, let's jump forward to what are lots in Forex. A simple way to understand what is a lot: it is a transaction amount of 100,000 units of a currency. I hope you got that, and if not, let me explain further. Forex is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. A lot is a unit measuring a transaction amount. This amount is set at 100,000 units. When you place orders on your trading platform, orders are placed in sizes quoted in lots. The standard size for a lot is 100,000 units of currency, and now, there are also mini, micro, and nano lot sizes that are 10,000, 1,000, and 100 units. Standard lot 100,000 units. Mini lot 10,000 units. Micro lot 1,000 units. Some brokers show quantity in lots, while other brokers show the actual currency units. As you may already know, the change in a currency value relative to another is measured in pips, which is a very, very small percentage of a unit of currency's value. To take advantage of this minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss. Let's now explain what is leverage. You are probably wondering how a small investor like yourself can trade such large amounts of money. The answer is leverage. You can use $1,000 to trade $100,000. Think of your broker as a bank who basically fronts you $100,000 to buy currencies. All the bank asks from you is that you give it $1,000 as a good faith deposit, which it will hold for you but not necessarily keep. Sounds too good to be true. This is how Forex trading using leverage works. The amount of leverage you use will depend on your broker and what you feel comfortable with. Typically the broker will require a deposit, also known as margin. Once you have deposited your money, you will then be able to trade. The broker will also specify how much margin is required per position traded. For example, if the allowed leverage is 1% and you wanted to trade a position worth $100,000, but you only have $5,000 in your account, no problem, as your broker would set aside $1,000 as a deposit and let you borrow the rest. Of course, any losses or gains will be deducted or added to the remaining cash balance in your account. The minimum security, which we call margin in Forex, for each lot will vary from broker to broker. In the example above, the broker required a 1% margin. This means that for every $100,000 traded, the broker wants $1,000 as a deposit on the position. Let's say you want to buy one standard lot, 100,000, of US dollar to Japanese yen. If your account is allowed 100 to 1 leverage, you will have to put up $1,000 as margin. The $1,000 is not a fee, it's a deposit. You get it back when you close your trade. The reason the broker requires the deposit is that while the trade is open, there's the risk that you could lose money on the position. You can place stop losses on your trade to stop you losing money. We will be going over stop losses in a future lesson. I hope you now understand pips, lots and leverage. I am looking forward to seeing you in the next lesson. Help the channel to grow. Like, subscribe and turn on bell notifications. We hope you enjoyed the lesson and we will see you on the next one.